Well, good afternoon. Happy Friday, August 23rd. Mark Milam here, your mortgage professional. Let's get right to it. Interest rates had a pretty decent week. We saw interest rates improve a little bit, albeit modestly, from Monday through Friday. We'll take it. Monday, we started off in great territory. We're ending Friday with some note rates down into the fives. And hey, listen, we need it for affordability. But what made this week particularly interesting was a report that we got from the Bureau of Labor Statistics, the BLS, or as some people might want to refer to it after this week, the BS, because what we found out was from a time period of April of 2023 until March of 2024, that the federal government overstated job creation by 818,000 jobs, meaning about one third of the jobs that we said we created in that 12-month time period, we didn't really create. Let me show you what I'm talking about here. We'll go straight to some headlines. Yes, the government just erased over 800,000 jobs. Here's what that means. In other words, the Bureau of Labor Statistics just revised its payroll count by the largest number in 15 years. You have to go all the way back to 2009 to find an equivalent reduction. This is the chart here that you can take a look at, and these are the jobs that we subtracted. Interestingly enough, we subtracted 306,000 from the prior year. So 306,818 in the past 24 months, we have removed about 1.1 million jobs from the total number that we thought we'd created, right? And this is an article here from CNBC. Why this is different? Well, the last time we did this in 2009, obviously the country was in a pretty severe recession thanks to the mortgage meltdown. This time, the economy doesn't appear to be in a recession, at least not yet. Why is this so important? Why does it even matter if we have to revise these jobs down or what have you? And the reason it matters is because job creation is one of the most leading indicators of the strength of an economy. And the Federal Reserve has made no bones about it. Even more important than getting inflation down, the Federal Reserve is basing its monetary policy on the strength or lack thereof of the labor market. And when we continue to show this robust job creation from the non-farm payrolls, every 30 days we get this number that says, wow, can't believe how many jobs we're creating. We're not cutting rates anytime soon because we don't want to spark inflation again. Look at how strong the labor market is, or was, this week. We got that data. Why is the bond market or why is the stock market not reacting so strongly to this? Well, this is a little like a team that's finished the season. They went 10-0, and then they got audited by the NCAA, and the NCAA found some violations and said, hey, we're going to avoid 3 of those wins. You didn't go 10-0 last year. You went 7-3. Still a good season, but not quite what you thought it was. Well, listen, the stadium's empty. The lights are off. The game has been played. This is not really what markets do. Markets don't look backwards. Markets look forward. And so getting this data, it's important to get it right, of course. It's important to revise these numbers and really know what we're talking about. But you're a market that's saying, all right, well, that was a year. In some instances, that was almost a year and a half ago. We are where we are now, but it does call into question, how much can you trust these government reports as it pertains to the non-farm payrolls? And I'll close out with this on the BLS site. So the BLS site talks about this very thing. Why are we revising the numbers? Why didn't we get it right the first time? And they'll come down here and say, listen, why doesn't the BLS wait until it has all of the data to make the estimate instead of avoiding revisions? And then they come and blame it on the rest of us. They say that users of the data are intensely interested in the earliest possible read on labor market conditions, and experience suggests that the initial estimate is generally very good. Well, out of the past 18 months, 15 of those months have been revised downward. They haven't been very good. And if you just subtracted 1/3 of the job creation that you said that we had in the prior year, you had to do the exact same thing. Maybe we don't need to get this data out so fast, especially when it's wrong, and it's the primary barometer by which our Federal Reserve is determining the country's monetary policy. It's going to be very interesting to see how deep a potential recession goes and how much it's been exacerbated by incorrect data coming out of the BLS. Let's take one more look here at the Fed Watch. This is futures traders talking about the September 18th next Fed meeting. 63% of the money is on a quarter-point Fed rate cut. Take a look at this. 36%, a growing number now, targeting a potential half-point rate cut in the Fed funds rate. That would be a nice surprise for the markets, and I think we'd see a pretty good rally with mortgage-backed securities and mortgage rates continue a downward trajectory. In the meantime, if I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com. Have a good weekend.